And let's bring Brian Szytel in now for more analysis. He's Managing Director, Partner, and Co-Chief Investment Officer at the Bahnsen Group. So, Brian, what we've heard there is that we are hearing from both sides. The U.S. is saying that they've reached a framework to implement the Geneva Consensus and that they expect that rare earths as well as magnet issues will be resolved in this framework when it comes to trade negotiations between the U.S. and China. So what is your reaction so far to what we're hearing out of London?
Well, it's progress being made, and I think that is important for markets to move forward. We've seen the S&P rebound over 20% from the lows. We're just under 2% from the highs back in February and are up 3% or so on the year. So as the negotiations take place, it's more about just making positive progress here than anything else.
Yeah, do you think this will be enough positive progress to push markets even higher, Brian?
I do. I think a lot of the highest level of fear in the month of April is behind us at this point. We don't know exactly what the negotiations will end up giving us, but we do know that they're making progress, and we feel that once they get to a point of finalizing something, whether it's rare earth deals in exchange for higher technology on chips or something of the like, that markets have pretty well priced that in at this point, and we're focused back to fundamentals. Fundamentals have actually been pretty sound in the U.S.
Yeah, so it sounds like, more details would be helpful in terms of understanding where negotiations stand at the moment and the details of the deal that they have agreed on. And you mentioned that U.S. stocks have recovered from Liberation Day losses, Wall Street close to all-time highs. In fact, do you think these are fair levels? And can you tell us more about what you're seeing in terms of fundamentals in U.S. stocks?
Well, by any metric that we look at, I mean, U.S. stocks are certainly not inexpensive at this level. We're trading at 22 times earnings. We just came off of a very solid Q1 earnings growth. We had 14% earnings growth. So at these levels, if you looked at things like the equity risk premium, for example, and compared the earnings yield on the S&P versus the inflation protected Treasury yield, you're at about half of what is historically the norm. And so I say all these things not to necessarily frighten listeners or investors away from U.S. equities, because they shouldn't be. There's just a need to be selective in this market. And where we tend to play is in that dividend growth sector more. And I would own many names there, and I would shy away for some of the broad indice exposure at this point.
I see. And these valuations come even as the World Bank lowered its global growth forecast due to tariffs. They said that the global economy is on track for its worst decade since the 1960s, but they did stop short of forecasting a recession. What is your take on the economic costs of this trade friction, despite the positive signals that we're getting from London?
Well, we went through the best case study of what happens to global growth when you basically shut it completely off in the pandemic. And so this is a much lighter version of that. What has already transpired was a very short period of time. Ultimately, how tariffs get priced into things and how the world markets behave after that will be a subsequent result. But it isn't going to be anything like the pandemic, number one. Number two, GDP growth in the U.S. is expected to be positive. It's expected to be positive in Europe. And so, and globally, and particularly in China. And so there's still plenty of reasons to want to own equities and risk assets in this market. You could look at high yield credit spreads at basically not quite all-time tights, but now from 450 wide in April back to 312, something like that now. The environment is not speaking to something where growth is falling out of bed at all. It's speaking to something of some uncertainty getting worked through on trade, but fundamentally, employment is remaining low, at least in the U.S., and growth is continuing on. And so there's still an investable landscape here.
So an investable landscape there in the U.S., but what does that mean for the U.S. dollar, which has been on decline this year?
The dollar has strengthened for 10 years at this point. And so, having the dollar come down a little bit, I think is fine and normal. It's not out of any range of normalcy over the past 10, 20 years. I think media catches a hold of some of these headlines and maybe, it exaggerates here. But when you look at U.S. yields, are they higher than, say, they are in Europe or Japan? Yes, they are. Are they still attracting plenty of buyers at each of the Treasury auctions? Yes, they are. Same thing with the dollar. As long as the U.S. market remains in positive growth territory and remains open and transparent to the rest of the world, those things will oscillate here, but there's still a very attractive investment paradigm for foreign investors in the United States.
Appreciate your insights today, Brian. Brian Szytel, their managing director and partner and co-chief investment officer at the Bahnsen Group.